Okay, here's what you need to focus on for the monetary policy test. First of all, money has three functions. Number one, it is a medium of exchange. You buy stuff with it. That's a crystal ball. Mediums use crystal balls. Get it? Number two, it is a unit of account. That means it is a yardstick of value. $40,000 house, $900,000 house. Tells you something about the houses. Number three, money is a store of value. You can put money in the mattress and pull it out a year later and still buy stuff with it. You can use it to transfer buying power to the future. Okay. Inflation and deflation. What we need to remember about that is that inflation, when inflation is occurring, prices are going up, and the money supply is inflating. Since there's more money, the value of each individual dollar, however, is going down. Deflation is the opposite. Of course, prices are going down. The money supply is likewise deflating. Since there's less money, however, each individual piece of money is worth more. I want you to remember three things about the Federal Reserve system, Federal Reserve Bank. First of all, it is managed by 7 governors, the Board of Governors, appointed by the President. One of those is made the chairman. It is comprised of 12 regional banks. That's a map of the United States, obviously. 12 regional banks. The Federal Open Market Committee, the most important part of the Fed, which determines the level of the money supply or monetary policy, is composed of 12 members. All 7 governors, 4 Fed presidents, regional Fed presidents on a rotating basis, and always the New York Fed president. That makes 12 people. Those are the 3 structural things about the Fed you need to know. All right, so you need to remember the rudiments of fractional reserve banking. This bank, for example, has $100,000 in deposits. Let's assume that the reserve ratio is 10%. That means they have to keep 10% in reserve. That's $10,000. So happens that's exactly what they have on the asset side. Therefore, they have 0 excess reserves. This bank cannot make any new loans. When you're evaluating how much new loans a bank can make, look at the reserve ratio, look at the deposits, and see what their current reserves are. If they have the exact amount they need, they cannot make additional loans. Other thing to remember about banking is that banks have 2 competing goals. One is profit. This pi sign is a financial symbol for profit. Profit. On the other hand, they also need liquidity, ready cash for safety. These 2 goals are at odds with each other. It's the challenge of banking. Remember the 3 things about interest rates. First of all, interest is the price you pay for money. It's the price you pay for money. Secondly, interest rates and the money supply have an inverse relationship. Interest rates go up, that means the money supply is down, and vice versa. There's more money, it's cheaper, and interest is the price you pay for money. So if there's more money, interest rates go down. Third and final, interest rates and bond prices also conveniently have an inverse relationship. Bond prices go up when interest rates go down. Interest rates go up, bond prices go down.